Well, we've been assuming that a deal would, in fact, eventually take place, but that is hardly the end of all of the risks on the political front in the United Kingdom. And that I'd also just bear in mind that for investors, global investors, there are many things right now where political whims, political decisions are incredibly important in setting the pace of markets, exchange rates. And these are not the same sort of factors that we can really rely on, like forecasts for the economy, reasonable forecasts for how asset prices would perform. So these sort of risks have to be taken into account in all of our asset allocations, including for the United Kingdom.
So are these risks priced in to European and British assets at the moment, or not? Are they overpriced given the risks?
I think it's two-sided, in fact. And now you did see that sterling has weakened very sharply on a real effective exchange rate. It's down quite a bit. And you saw on the notion that there would be a deal, that there was a rebound. But it's very, very different if there were end parliamentary approval through the European Union. And so again, we see very two-sided risks for UK assets solely on these sorts of political decisions. Now, what does that mean for UK equities? You could see that in local prices, for example, they were fairly stable. They have high dividend yields, over 4%. And that's really not where the issue is. It really does come down to the exchange rate sort of bearing the brunt of any valuation adjustment. But this, again, is a reason why local investors would have less volatility, have probably better returns if they were invested across regions. Now, for your US investors, I'd bear in mind that this is a sort of issue that's going to be very, very local in its impact. It matters for the EU, it matters for the United Kingdom a great deal. But it's not going to matter for all global equities or US equities, beyond a short-term impact.
Stephen, would that change if you have a no-deal Brexit? If you have a hard Brexit, does that actually become a much bigger, more widespread situation? What does that look like if it happens, since the possibility of it seems to be increasing?
Well, it would be, for example, falling back on WTO rules for the United Kingdom. But I think if you take a look at most of these regional shocks away from 2008 and 2009, an exceptionally rare outcome, you find that most critical issues play out in regional asset prices. Take a look back at 1997, 1998. Southeast Asian GDP fell much more than we would ever imagine the UK would on a Brexit deal. And it didn't slow global growth at all. Had very material regional asset price impact. We saw this in the case of Brazil just a couple years ago, where very, very severe circumstances had very little global impact. I think if you were to switch to Europe more broadly and think about threats to the European Union, the Italian situation, then you're thinking about something that rises to a larger scale. But still, it's very, very rare that beyond, let's say, a couple days or even a month, that you see the world economy and world asset prices, lastingly affected by what are regional issues that affect regional economies.